Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee Area, this time March 2024. Super interesting stuff today. It looks like the Milwaukee market is going into a change. We see the market shifting. We call this an inflection point. This is when the market goes into one direction for several years, and then you hit that point where it starts changing direction, and it looks like that's where we're at. So we'll look at this today. Then I also have the first set of data on how much Milwaukee buyers have been able to negotiate on deals, or did they pay over list price. So we'll take a look at that, and I have it broken down for individual deals so you can see how much money the prices were negotiated. And then we're going to take a look at the latest from the economy and how that is going to impact the Milwaukee real estate market as we're going into 2024, and further into the spring market, I should say. As always, let's take a look at the latest numbers from MLS. Inventory is my first number here always because it's so important. Inventory is basically the result between the forces of supply and demand. And if you see inventory going up, that means supply and demand is shifting. And that's what we're seeing, 25.8% increase in inventory. Be careful, it's the magic of the small numbers. So we're still very, very low. You can see pre-pandemic in February 2019, we had over 5,000. And if you go back to 15, we had over 10,000 units on the market. So still very tight inventory, but nonetheless a 25% increase, which is remarkable. Sold units are within the range as of expected. Days on market, 25 days on market. That is a significant slowdown that we're seeing in the market. I've been seeing this in January and February, but we had to wait to have the data on it to actually show it. You can see last year we were at 16 days, still very, very fast compared to previous years, but a significant change to what we have seen in the last 2 to 3 years. Prices are up 6.4% in February. We're now at $291,000. If you look down, February 15, 149. So prices have basically doubled in the last 9 years. So the market feels very different in the first 2 months of 2024. And I have finally enough data that I was able to slice and dice for you to show you what exactly is happening. We have a lot of strange ambiguity in the market. The market is it seems like to contradict itself. And we're going to take a look at that. And this presents, of course, as always, when you see a change, this presents certain threats and certain opportunities if you know what you're doing. So let's take a look at that. The first thing that I want to show you is how quickly houses are selling. So it used to be a thing, I'm sure you're aware, over the last few years, houses go on the market end of the week and they're sold by Sunday. You can barely get in, you barely have time to write an offer. And so this is changing. I have here as a benchmark 2023. The first 10 weeks, so all the way from January 1st to March 10th of the year for the 4 counties, Milwaukee, Ozaukee, Washington, and Waukesha County. That's our area here. And we analyzed 1,870 deals and found that last year, this time, 55.6 of them went under contract on the first 7 days, which is typically on the first weekend. So we've seen this. The data matches up with our experience. Now, if you look at this year, this picture looks a lot different. Mortgage rates were about the same. So we went from 6.5 to about 6.7. So that is not enough to explain the difference here. In fact, from a psychological point of view, we came down from almost 8% mortgage rates. So it feels 6.5 feels better now than it used to back then when we were on the way up. But only 25.7% of all listings went under contract on the first weekend. The interesting thing is, or the weird thing is, if you see a reduction like this, you would expect the market to be less competitive. If you think this way, it's a fair assumption, but it's actually wrong. Let me show you. So most of the listings that have sold so far, if they have sold very competitive. You can see here the blue segment represents listings that sold right around list price, plus minus 5%. There's some wiggle room with inspection negotiations, whatnot, but right around list price is about 1/3. Almost half of it, 49%, the green segment, has sold over list price. So this is $5,000 or more over list price. And only this small share, 16%, has sold below list price, where people have been able to negotiate a little bit. So that shows how sellers are holding the line. They're not willing. And so a listing is either going under contract or not at all. And then it's just sitting. And this is why you see inventory going up. This is why you see days on market going up. Here I have the breakdown. People are always super interested to, they always ask me how much or how many dollars over list price are hot deals actually selling. This is actual data from, the first few months of the year. And every dot here represents a house that has sold in Milwaukee this is days on market. So we have your 20, 40, 60, 100 days on market. You can see these are all bunched together here. These are the 25% that went under contract right on the first weekend. And you can see most of them $10,000, $20,000, even $40,000 over list price. A lot of them are right here on list price, and as time goes on, there is more and more room for negotiation back here. So that is interesting. The trick here is really to know when you're looking at a listing, is this a hot one or it's not? If I'm representing a seller, we try to make it a hot one and create a competitive bidding situation. If I work with you as a buyer, then it's very important that we understand the difference between list price and fair market value, and we get a good estimation of how competitive this is going to be. And that makes all the difference. Knowing this takes a lot of experience, and I can help with that, but I can only do it if you reach out to me. And before you do that, I would encourage you, look me up online. We have a lot of reviews on Realtor, on Zillow, and on Google. They're 5.0 on average. And so, look me up, and before you reach out to me, if you want to, you can just send me an email. You have my contact information here right on the screen. A lot of people are doing this after they've watched one of my videos, but you can also go on our website, onpointrg.com. There's a lot of resources there for you. For example, you can download our brand new Milwaukee Buyer's Guide that walks you through the process and how to gain a competitive edge in the market. You can schedule a meeting with me. You can have access on my calendar and see when I'm available. Just pick a time that works for you. My office is in Whitefish Bay. We also have an office in Wauwatosa, or we can just hop on a Zoom call or on a phone call, whatever you prefer, and we can talk about your personal situation. And also, almost forgot, you can sign up for MLS access on our website. So onpointrg.com. With that, let's go back to what's going on with the economy. So it looks like we are going to actually see a soft landing and not a recession. A year ago, a lot of the economists were predicting that we're going to see a recession in the next 12 months. This picture has literally flip-flopped. Now only 39% are expecting a recession in the next 12 months. So that's good news for the economy, but maybe not great news for the real estate market, depending on which side you're at. The other factor that plays into this and into the decision making of the Fed, because that's ultimately driving rates, is the unemployment rate. As you know, the Fed has the mandate to keep the unemployment rate in a good range. They also have to manage inflation, keeping that in a good range. And these things are somewhat contradicting, so they're trying to work with that. And when we look at unemployment rate at the moment, Wisconsin has a 3.4% and the US 3.9%. So we're doing better than US average. I'm very proud of that for Wisconsin. But unemployment rate is expected to increase for December of 2024. The Wall Street Journal survey here is expecting 4.3%. Now, that's not a recession. Anything under 5% unemployment rate is still considered a relatively tight labor market because the long-term average is 5.7%. But what it does is it makes the Fed pause, because they were trying to cool down the economy in order to get a grip on inflation. And one of the things that they can tell they're actually succeeding in cooling down the economy is that companies are getting slower in hiring people, and unemployment rate is ticking up a little bit. So we've been waiting for this. That's kind of the soft landing that we're looking for. But we're going from a super tight labor market, and the latest numbers are still very strong. The economy is still very resilient, and that makes the Fed keep the rates where they are a little bit longer. Here's a statement from a senior economist from LendingTree, one of the major mortgage originators in the US, and he said, "At least right now, the fundamentals of the economy are doing pretty good. While things are far from perfect, the economy is probably doing better than people want to give it credit for." And that's also what the Fed is looking, because they're trying to get inflation under control. And we have the latest numbers. Actually, this morning we got the March Consumer Price Index, and it came out at 3.2%, which is up a little bit. Last month was 3.1%. And because of that, the Fed said, okay, we're going to hold off on immediate rate cuts. It's still possible that they're cutting rates, but it's more likely that we have to wait until summer for this to happen. And that will impact your credit cards, that will impact your car loans if you buy a car, and indirectly that will also impact mortgage rates. And the reason why they're being so careful right now is because you can look back here into the 70s. When we had very high inflation, came down, then they started easing too soon and it spiked up again. It was really bad. Mortgage rates were at 16, 17% at the time. It was very painful for the US consumers and for the economy. And they're trying to avoid this. We came down nicely, and now we're here in this decision-making phase but we're not sure. Are we spiking up again, or are we coming down? And they want to make sure that we're going down to 2% inflation. And the big issues of this month's consumer price index increase were an increase in housing cost. So rents are going up at a pace of about 6% per year, 0.5% per month. So that has a huge impact on the consumer price index, is the cost of housing. And the other chunk that made it move up was the price of energy and the price of fuel that has gone up over the last weeks. So for these two things, we have not seen inflation coming down. A lot of the other things that we've seen, like used cars and groceries, etc., a lot of them are slowing down as predicted, but housing remains very expensive and rents are increasing, as well as home prices. That's why they have to pause and keep rates where they are for a little while longer. Now, consumer confidence in home prices is improving. This is a chart from Fannie Mae that measures how many of the consumers are expecting home prices to, quote unquote, crash. You can see long-term historic reference has been just under 10%. And of course, it spiked here with the pandemic. And then when we saw the pandemic wasn't as bad as we initially believed, then things were coming down again. And then in 2023, again, we have seen these fears coming up about home prices crashing down. And I've made a ton of video debunking these myths. There was a ton of content on the internet and social media about home price crash is imminent, the real estate market is going to crash. None of that is really based on fact. So when you look at the data, and I'm not going to repeat all of it, but long story short, as long as you have a chronic housing shortage and there's not enough inventory, there is no reason for sellers to give you a discount as a buyer. Only if the market is absolutely flooded with inventory and people have to sell their house, then sellers are starting to being compelled to lower their prices. So the fundamentals of supply and demand were absolutely pointing in the opposite direction. And we can see now consumer confidence going in that direction as well. More and more people are realizing, no, it's not going to crash. There's just not enough houses here for that to happen. Professional economists are adopting that mindset too. You can see here the forecasts from the end of last year. We have them here compared to the new forecasts that just came out in the last weeks here. And all of them are going to be more positive now. Goldman Sachs here has revised, for example, from 1.9 to 5.5%. So, of course, this is just a data model, and we will have to wait and see what's going to happen. Interest rates will have a big impact on that, but nonetheless, institutional confidence in home prices for 2024 has increased substantially. And by the way, nobody here has predicted home prices to actually go down. So that's interesting to see, but now they're more optimistic in terms of how much they might be going up. As you know, I always feel when you look at data, context is very important. So when you talk about home price appreciation, what is actually the long-term average? And here we have a chart that goes back from to 1980. So that's the last 43 years of how much home prices went up every year. And of course, we have here the famous 2008, where we had a total exuberance of inventory that brought home prices down. But for a normal economic recession, you can see that home prices maybe didn't improve that much, but they stayed there. The difference is that now we're in a situation where we have an absolute chronic housing shortage. For the last 14 years following the 2008 crisis, we have way underproduced inventory. And so for 14 years not making enough houses, now it finally shows up as a result on the supply side that we just don't have enough houses in the US. We're short about 5 million units. And even if the home builders are cranking it up to maximum production, it will still take 5, 6, 7 years to catch up with that shortage that we have here. So it remains to be seen, but where things are going. But 4.86 is the long-term average. And the reason why I put this here is because I want you to take a look at the latest home price expectation survey. So those are 100 top economists that are being interviewed once a quarter. There are some that are more optimistic, there's some that are more pessimistic, and then it all gets averaged out. And what they're saying is that home prices will continue to go up over the next 5 years, but at a rate that is less than the historic average. Remember, historic average 4.86%, and they're looking more in the 3 to 4% range. So a little bit less. But if you play this out over the next 5 years, if what they are modeling out right now is going to happen, a $400,000 house will appreciate over the next 5 years by $83,000. So nobody knows, of course, how this is going to work out. Home prices can always fluctuate. There might be a year where you see less appreciation, but overall, this is what they're expecting right now. Let's take a look on how Wisconsin is doing compared to the rest of the country. And I always find this fascinating because Wisconsin historically has been a really, underdog, kind of low performer in the U.S. real estate market compared to the West Coast and to the East Coast, and in latest years compared to Florida and Texas. And here we have the data from the Federal Housing Financing Agency. So they're saying national average of 2023 home price increase was 6.5%, and Wisconsin beat that with 9.3. You can see there's only a handful of states that actually went double digit, and they're shaded here dark blue. The interesting thing is that a lot of the high-flying states, if you look, for example, on the West Coast, we have outperformed them significantly because our home prices are still so much lower that people are taking advantage of this because you can just buy so much more house here in the Milwaukee metro area. The affordability is still much, much better. Here I have a chart that shows you the comparison between Milwaukee metro area home prices, so that's the whole 5 county area, over back since 2012 in green here. So this is Milwaukee. You can see very strong seasonality. We always have this summer spike, winter low, and this data point here, that is actually December of last year. So we're still waiting for 2024 data here, but you can see we're well below the national average. And of course, national average is an average. So there's a lot of markets on the East Coast or on the West Coast that are much, much higher. They would be here on top because they're so much higher than what we're looking here in Wisconsin. So what's going on locally and, on a month by month? So here you have the discrepancy between sellers and buyers. The blue line are new listings that are coming on the market. And you can see how this has jumped up from December to January and February. So these are the new listings hitting the market. And the green line is deals that have closed. So that's basically what the market is willing to carry. And every year we have a gap here. You can see this also last year, but the gap this year is exceptionally wide. So the sellers are really setting the bar very, very high. And it remains to be seen. We will see this in about 4 weeks, what this green line is going to do if the buyers are willing to come closer. You can see last year, these were a lot closer, and then usually takes until June for these lines to merge here and to cross. So we'll see, but here's what we can expect short term for the Greater Milwaukee area. Rates are expected to go sideways. So short of the Fed changing anything before summer, we are most likely going to see mortgage rates remain in that middle 6% range. So it will go up and down a little bit, but it's not going to change the direction of the market short term. If and when rates are going down, that's going to bring a lot of people back. We know from research that 5.99 is that magical number. As soon as it begins with the 5, a lot of people will feel it's time to get into the market and buy a house. And that will have an impact, of course, on home prices. So it's a much smarter play if you're planning to buying a house to not wait for rates to go down, rather buy it now before prices are going up and then refinance into a lower rate. Usually if you see a full 1% rate drop, it makes sense to spend the $2,000-3,000 on refinancing. Inventory will increase slightly in the next few weeks. I think we're going to see an increase in the trend. It's not going to be monumental or like a total game changer. There's no flood of inventory, but I think we're going to see more listings coming up. We have several coming in the next few weeks. But we'll also see a slower pace in the market, and that means there is an opportunity for buyers. Days on market are getting a little bit longer than they have been in the last 2 years. So there is a major change from that crazy velocity that we've seen, and that presents an opportunity for buyers. Hot listings, as we have seen, remain very competitive. 84% of them are still selling at list or over list price, and some of them really high. And like I said, knowing the difference is really key when you're shopping for a house. And listings have to be right on point. So if you are a seller, it's very important to really position your house correctly. So you are in the 25th percentile in the top range that is performing really well. That will get you the most amount of money for your listing. Preparation is key. You want to be sure that your house really shows the best way possible, that you're not spending money on things that are not relevant, but you're doing the right things. And we can help with that. If you want to reach out to me, you have my cell phone and my email address right here below. That's all I had for you this month, and I'll see you next month.